Hi, good evening, everyone, and welcome to CLSA's India Forum. With us today, we have the management team of Bajaj Finance presenting at our webinar. We have Rajiv Jain and Sandeep Jain with us. I think they don't need any introduction. Rajiv has charted an ambitious growth path of the company, transforming it from a captive auto financier to one of the largest NBFCs in India. Before starting his journey at Bajaj Finance, he was associated with American International Group as the Deputy CEO of the consumer business. Prior to it, he had a variety of experiences across American Express, GE Money, across credit cards, personal loans, and business loans. We'll have the webinar with 5 to 10 minutes introductory comments from the management and then open it up to Q&A. Over to you, Rajiv.
Thank you, Biran. Thank you, CLSA, for hosting us. A very good evening or good morning to whichever geography you're in. My name is Rajiv Jain, and I have with me Sandeep Jain, who's the CFO of the company. Essentially, we are 20 days into the Q2 results that we did. We did our results on 26th of October. It's only been 20 days. The only event during that period that's happened fundamentally is the season that's gone by. So I can just provide a quick update on that, followed by how are we doing on the business transformation, which is to go live on 15th of December. I'll provide these two updates and open up the floor for questions. Overall, I would say we remain in absence of a third wave, with every passing month, we are a lot more confident. I think all business metrics across growth, risk, debt management, and financial metrics are fast normalizing with every passing month. That's a good sign, makes us reasonably confident of the second half of the year. And in our businesses, if you have a good start, exit rate in the previous year, you normally have a strong entry rate into the next fiscal. So barring third wave, I think we're looking at, I would say, we're quite excited about the second half of the year and the forthcoming fiscal. The season that just went by was good between 20th and was okay between 20th and 30th, was very strong between 1st and 7th. The season ended on 7th of November, 3 days post Diwali. In terms of volume momentum, I would say it's good. In terms of value momentum, it's been much stronger. So the volume growth is, as I said, good, but value momentum is much stronger. In addition, all businesses are in reasonably strong growth momentum. That's really how we're seeing at this point of time. So it's not just pure discretionary businesses of ours, which are B2B businesses, but across B2C, rural growth was much stronger. Even when we compare rural and urban, both in value and volume, or volume and value. So rural momentum at this point in time, we're seeing it to be much stronger, both B2B and B2C. The mortgage businesses are growing nicely. We are in a reasonably strong investment mode, not just in the digital transformation that we're doing, but even otherwise in terms of geographic expansion, in terms of investing in our future. Of course, reflects partially in the OPEX to NIM matrix in the short term. But from if there is no third wave, I would say the next 2-3 years for the company should be reasonably strong. Coming to there's also just one more update. I think RBI came out with 2 sets of regulation. There's a scale-based regulation that got announced on 26th of October only. Actually, overall, I think it's very good for non-banks and should create significantly more sustainability for the sector, and we really welcome it. There was a set of guideline changes that came last Friday, which were essentially effective immediately. Overall, its impact on the company will be positive. As a company, in terms of because we've been conservative in the way we manage our risk cost. Going to business transformation, it's been delayed. Clearly, a lot of crunch in terms of tech resourcing, lots of open positions, but I think we are reasonably well on track for 15 December go live as phase 1. As I've said to various investors over time, this is now the way we'll conduct business. This is now how we will run the company. Anything and everything that we do from a consumer-facing standpoint will be through this business transformation initiative of transitioning to this whole new app ecosystem of 5 apps that we're launching. 2 of them in public domain and 3 behind the scenes to enable or what we call productivity apps. So that's really the update in the last 20 days post Q2. And I'm happy between myself and Sandeep to take any questions that you may have.
Thanks, Rajiv, for the update. While the questions queue up, if I may just ask more from a medium to long-term perspective, barring auto loans, of course, where I presume we will slow down on growth, do we expect all other segments to go back to pre-COVID levels of growth, or are there certain segments where you see more competition, for example, mortgages, where it has intensified a lot in the last 18 months? And maybe over a medium term, growth does not go back to pre-COVID levels. So are there any such segments where you think you would be a bit more skeptical on growth?
So eventually even auto loans should start to grow, or auto finance should also start to grow from, I'm hoping from next fiscal. That's point number 1. In mortgages, our relative size is much smaller. So we see, because of the tailwind of the size, we see growth opportunities, and the investments that we are making in the business are, I would say I'm quite bullish about the mortgage growth. Its contribution should remain between 34, 35, 36% of the overall balance sheet. I'm not seeing any headwinds in any of our lines of businesses in terms of their pre-COVID growth momentum. The only point I would make, Piran, is that the competitive activity is quite intense at this point in time, essentially leading to what I would define as mispricing of risk, because the overall credit growth remains quite anemic. You know, even if you take the 28 September data, I think that's what we saw in ALCO, I think 6.5% growth in terms of overall credit growth on a year-on-year basis. So things are still anemic from an overall bank credit growth standpoint, leading to a lot of intensity of competition in across all asset classes in the retail space, leading to what I would call mispricing. And I have a strong point of view on this. I've said it in the past that I'd rather not lend than to misprice risk and lend. So, but it's so far not coming into the way of growth, and we'll play along.
Got it. And when you mentioned that, the Friday circular of RBI on asset classification is good for you, could you just please elaborate on why it would be good and not maybe neutral or negative?
So Piran, the earlier regulation for NBFCs talked about months overdue. So RBI would say that any account which is 3 months or more overdue needs to be classified as NPA. Now, as Bajaj Finance, what we used to do is a customer who has banking date on 2nd or 5th, all the customers at the month end were being stamped as 1 month overdue. And of course, if you follow the sequence, 2nd month becomes 2nd month overdue, and 3rd month, of course, 3 months overdue, requiring you to classify that account as GNPA. Okay. Now, if you go by the circular that is issued by RBI for NBFCs and for the entire financial system for that matter, on Friday, it now requires that an account which has crossed 91 days past due. The circular very clearly defines that from a month's overdue that was defined for NBFC, now we have to move to days past due. Now, these customers, as on the reporting date, were not necessarily 90 days plus. They were probably in 86 to 89 days overdue position. Yes. As a result, if I were to follow the RBI regulation in form and spirit, a large part of the customers who are currently sitting in 3 months overdue and were hitherto classified as NPA by Bajaj Finance may not necessarily classify to be NPA on an incremental basis. However, this is only one part of the story. The second part of the story is that as an NBFC sector in general, because of the RBI regulation being only for months overdue, not classifying when the account should be upgraded, all the NBFCs in general are following a practice wherein as soon as the customer pays one installment or more and comes back to less than 3 months overdue, the account was classified as standard. We have done a broad level analysis looking at our empirical data of the customers who are currently live as on 31st of October. There is a small set of customers who were earlier in NPA but had paid 1 or 2 installments, have not gone to a level of zero delinquency but were classified as standard.
Stage 2.
Those customers are now going to get classified as NPA. We are doing all the sums at this point in time. Broadly, we believe that the release on the NPA number on account of 91 days cutoff is expected to be higher than the amount that will get classified into NPA as a result of rollback criteria that has now been put in by RBI.
And it's a good harmonization. I must just make a point. I think vis-a-vis banks, and I think it's good for the sector.
So that's one part of the story, which is on the NPA side. As Rajiv said, we have remained always conservative in terms of how we approach provisioning for bad debts, even customers who are in stage 2 for that matter. While the account may get classified as per the new regulation as non-NPA, the management team will consider if it is appropriate for us to carry forward the provisioning that was already created on those accounts. In a way, do a grandfathering of provisioning until the standard customer goes into absolute zero overdue in future. So that's something that is being dwelled upon by the management team. We will, of course, take the call on that by end of the quarter.
Okay, that's good to know. And Sandeep, one question for you: how well positioned are we in case interest rates in the economy, rise next year, as most economists predict, in terms of protecting our margins?
So, Piran, if you look at the ALM schedule, very clearly we are positive on ALM. Our liability maturities are longer than the asset maturities, which also means, and over the last 1 year, we have focused in terms of, one, reducing the exposure that we have from banking system to the company, working with the banks in terms of repricing the loan wherever appropriate and possible for us. On the other hand, we have focused a lot in terms of borrowing long-term monies. I think these are not the rates that we have seen historically in the last 10 years. Wherever we are finding windows and opportunities, we are raising long-term money. In fact, in the September month, we have raised almost 2,500 crores of 10-year money at 7.1% coupon rate. I think given the kind of attention that the company has given from long-term sustainability of liability profile and interest cost, I believe that as the interest rates start to rise, I think we'll be positively benefited by it. However, we remain committed that as the rate of interest starts to move upwards, as we have always done, if we see rates rising, borrow long. If you see rates being far more affordable, borrow long. So we'll continue to maintain that positive ALM approach in the company. However, on an overall basis, we think we are reasonably confident that the margin will remain protected.
Okay, that's good to know. Okay.
In addition, as the last point, that look, we've been carrying a lot of surplus liquidity, given the environment. As things normalize, we are winding that down. Essentially, surplus liquidity is left in liquid mutual funds or in T-bills, creating a drag. As things normalize, and we've said that in our update in second quarter, as we normalize that, net that adds to the profit momentum as a result of normalization of the liquidity buffer which we carry. We've carried at the peak of it 8-9%. In general, for the last few years, we've carried 4-5%. So we will see that benefit naturally emerge to the business.
Got it. I'll now open it up to Q&A. I'll just go through some of the questions that are here. Okay, the first question I'll read out verbatim. Now that Bajaj Auto is starting their own financing arm, will we completely exit the two-wheeler, three-wheeler business, or will that remain a part of the book but with more OEMs?
So look, fundamentally, the Bajaj Finance was originally Bajaj Auto Finance. That's really what the company was. We have been a captive for the last 33 years as a company. We will continue to work with Bajaj Auto. Number one, it'll take a while before they establish this and start on their own. So I think over the next 6 to 8 quarter horizon, subject to regulatory approval, they'll continue to be our strategic partner. That's point number one. Point number two, as they build it out and they build it out fresh, it'll take longer for them, so they'll continue to work with us. Point number three, we're also evaluating in the process whether we would like to also do open architecture two-wheeler financing. So given our huge geographic coverage and the depth that we have, when we look at our bureau data out of our 53 million customers, that how many customers have ever taken a two-wheeler, numbers are really large. So there's an opportunity for us to pursue open architecture two-wheeler. We're evaluating whether we would want to get into open architecture two-wheeler as well. So that's really what the short term and the medium term on the initiative by Bajaj Auto could look like from a Bajaj Finance standpoint.
Fair enough. That answers it. I think Deepak Agarwal of Axis Mutual Fund has a question. Deepak, if you can unmute yourself and go ahead, please.
Yeah, Rajiv. Thank you for your time. Rajiv, just wanted to understand, if you look at all the BNPL players put together, what kind of GMV all of them would put together would be doing? As I understand, we would be doing about $8 billion worth of GMV annually. Any rough numbers in terms of how much they would be doing collectively?
I won't know, Deepak. We know that we are booking 25, 27 million accounts annual run rate across various products, and would move $8-9 billion, as you said. We have seen, let me make a point on the season, we have seen overall competitive activity soften. Let me make that point actually, for the season. So actually in the last 4 odd years, this was the softest season in terms of competitive activity I saw. Caused by what I'm not very clear. The only reason I can attribute is significant impact of second wave on companies who are intensely competing prior. It's not been an easy time in the last 18 months, and so that's really the only thing I can attribute to softening of competitive activity at the point of sale. We look at ourselves, we look at how we are transforming customer experience, we look at how we can mine our data, customer franchise, prospect franchise, to do more with the customers. Just the EMI card business is now originating, if I give you an example, 225,000 new customers on a month-on-month basis. This itself gives us a 1.5 to 2 million 2.4 million new customer run rate, which as a framed and exist a year ago. So if our new customer acquisition run rate was 7 to 8 million a year, I do believe that this itself gives us a million, 1.5 or 2 million, if the capability continue to remain strong, gives us a 9-10 million new customer acquisition run rate. Stickiness is very high of this base. 68% of the loans that we book on a month of these 26-27 million loan run rate that we had are existing customers. So they are quite sticky. They come back between 5, 6, 7 months to take another product. Not all of them, just off the loans that we book. I think is the only point I would make, Deepak, to the question.
Great. Second thing, so yesterday I was attending a presentation by Kakao Bank, and they put up some interesting things, like they want to completely digitize, completely on mobile itself, the experience of taking a home loan. I understand regulations are different, it's far more developed, but can something like that be replicated in India in foreseeable future?
Look, mortgage is a art business. We are talking science businesses. I think at a design level, what we've seen is that, and that's why we subsidize the mortgage company. Keep the science businesses separate from art businesses, and both would grow. You try and confuse, you have a problem. So I would, average exposure is, let's say, in the mortgage business, our average exposure would be, let's say, $50,000, $60,000. Average weight of the file or the papers that you would gather would be probably 400 pages. You can digitize anything. Do you need to? And the number of files that each person booked, or the number of loans that we book, if there are 3,000-4,000 loans in a month, then do you need to? So for the sake of it, you can. Its effectiveness relative to the business, I would say very low. So that's you can digitize. Anything can be digitized. Its effectiveness, I have a lot of question marks on.
Got it. Thank you so much. Thank you.
Thanks, Deepak.
High velocity businesses, Deepak. Just the last point I would make is wherever there's high velocity, that's really where technology is a big role to play. Otherwise, automation benefits corresponding to the investment does not pay.
Got it. Great. Thank you.
Thanks, Deepak. The next question says, as one of the pioneers of BNPL, what role do you think will the next fintech players play? Will they end up expanding the market? So I guess, is it more of...
Every dollar lost expands the market. So at a design level, it will expand the market. The last installment is really where the profit is in the transaction. Whether you do a 3 months BNPL, you do a 6 months BNPL, or a 9-month BNPL, or a 12-month BNPL, let's say for a moment. The last transaction is really where the money is. Going back to Deepak's previous conversation, there's not much data that is available in India in the domain. But when I look at, let's say, an Australian company and so on and so forth, you find their 30 days past due is 21-22%. You can never make money, whether in Australia or here, at those levels of default, or anywhere in the world. That I can tell you after 28 years of experience. Last installment is really where the money is. To create a sustainable business in financial services, you need to get that last installment, whether you're in a lending business or a BNPL business. So those who can do that efficiently are the ones who will create a sustainable business model. Opportunity is large. There's no question about it. I mean, we've been on this journey for the last 15 years. We never thought we would be doing 25-26 million loans a year. We never thought. But we do think that we could be doing 40-50 million loans a year in the next 3-year horizon. Just by the sheer omnipresent frame that we are pursuing, which is that, is it possible we'll be in 4,000 cities and towns in India? Yes. And is it possible that at an omnipresent level, we'll be present digitally, both digital web and digital app? Answer is yes. Aggregated together, can we be doing 40, 45 million loans a year? The answer is yes.
But so if I may just ask you a counter question on that, that would require us to move into, different categories also, right? Just being in consumer durables and digital products where we are already 70% of the market, we'll grow in line with the market. Isn't that fair to say?
Yeah. So we've been doing that for a long time now, Piran. That furniture, stem cells, low-speed bikes, coaching. I'm just thinking of cameras. I can go on. Mattresses. There are 27, 28 different categories that we fundamentally work with OEs on, or the ecosystem on. As I give example, cycles or so-called bikes, the bicycles like Giant and so on and so forth. So I just rattled 8-9 names to you. There are overall 26, 27 categories that we are continuing to develop. Now we are not developing them for any other reason. We are developing because the consumer wants it. Because the dominant is being electronics and mobile. We talk about it, but the lifestyle business was essentially conceptualized 5-6 years ago, mainly with the purpose of expanding new categories, and some of them over time could be pretty large. So category expansion is a ongoing process.
Got it. And another question would be that, what about partnerships with say payment aggregators or other people in the ecosystem? Like, for example, Zest Money has with Pine Labs, or Capital Float has with Razorpay. That gives them a, with one partnership, a massive distribution reach, right? Is that something we would consider? What are the pros and cons of, especially in the online world where we are not as dominant as we are in the offline world? Would we be open to considering such a partnership?
So fundamentally, now it's a point of view, need not be right. Let me flag that. The purpose of entire business transformation, 15 million customers use our current Xperia app, which in our assessment is, let's say, 3 on 10. As we launch on 15th of December, it should hopefully be 6 on 10. And hopefully by July, August next year, it should be 8 or 9 or 10. Okay, so that's level one. The point of view that I have is that we have the customers and we don't want to be relegated to be a balance sheet business. We want to own the customer. That's fundamentally the point of view I have. Customers are going digital, so we got to go digital. Now, so as I said, point of view is don't want to be relegated, want to own the customers. We bring entire suite of financial services products across lending, insurance, mutual fund in a single app ecosystem on 15th of December. And two, we have 53 million customers to work with, which are growing by 8-9 million. So I wonder what will partnerships give me. We can attract talent, we have the capital, we have the orientation. Our technology stack is organized to scale much faster than most people in the fintech space are able to do, because none of them that you talked about have 54 million customers and growing. So we want to compete and build for our consumers and own the consumers rather than build partnerships.
Okay, that's fair. I'll take the next question from Anand Bhavnani at Account. He's asked, the Finserv Markets app seems to be more advanced with the Markets Pay feature, whereas the Xperia app does not have the payment feature integration, and it looks inferior too. Can you kindly elaborate the reasons for it? Are we prioritizing development Finserv Markets over the Finserv Markets app over the Xperia app?
The observation is correct. 15 December, that will change dramatically. That's my limited point.
Okay.
Bajaj Finserv Markets is expected to be an open architecture app ecosystem, financial services ecosystem. We, as we launch on 15th of December, you will see the quote unquote the transformation that you're talking about, and it's a much larger ecosystem that will be visible to our customers and to the prospects that we've gathered working with our retailer ecosystem over the last few years. So just wait for that to happen, and you will see the change.
Okay, that's fair. The next question is from Geetika Gupta at iProve Life. She says, what led to the delay in the launch of the digital transformation journey? Were there certain business assumptions that went wrong and hence any change in business plans?
Answer is that essentially it's mainly just lack of availability of technology talent. I think there's just too much happening in the in the tech hiring space. And there is too much, number one, availability of talent, and in the process, when there's a demand-supply gap, and demand outstrips supply, you see mispricing of talent as well. So nothing else but that is what I would say.
Fair enough.
And we still continue to have a gap. We are building out as a company. We never used to hire fresh engineers. In the last 18 months, we've hired 300 engineers. Just in the current year, which means they'll come between Jan and June, we've hired 400 fresh engineers between various well-known engineering institutes. So the company goal is building talent grounds up parallelly. But as it does that, because of the change that we embarked on and at a very aggressive timelines that we set for ourselves, little did we realize that the tech crunch will be so large.
Fair enough. We'll take the next question from Dhaval, who's raised his hand. Dhaval, can you please introduce yourself also before asking the question?
Yeah, Dhaval from DSP. Hi, Rajiv. Hi, Sandeep. So just a question on the merchant part of the business. So I know you've talked about the merchant app and its rollout plan. Just the question was more from a medium-term perspective. Where do you see the retail merchant business and overall sort of the benefits both on merchant lending and consumer lending business? If you could talk about just the medium-term plan around that. So that was the first question.
Yeah. So the medium look. Payments and financial services is really how we are looking at the future for us as a company. That's level one conversation. We work with 120,000 merchants in 3,200 cities. They have an annual commerce of let's say 90 to 100 billion dollars. Okay, we today take of that, as Deepak said earlier, $8-9 billion, leaving money on the table between 91, let's say 8-9%, so 91% of the money is left on the table. 30-35% of that is cash. Balance is quote unquote digital payments. Starting point is, why should, instead of being 70% of his financing volumes, can we not be 75% of his total volume? That's level one conversation that we are asking ourselves. Parallelly, we have in 3,200 cities over 17,000 boots on the ground. None of the large payment aggregators have those. That's point number two. If you aggregate both these points and you say that we want to be a payments and financial services company, we see ourselves to be a large player in starting with P2M space, followed by P2P space. The P2M, the starting point will be our merchant ecosystem, which I talked about, and the value share that sits there. P2P will be using boots on the ground to build out the P2P business. Now, if you break the payments business into 3-4 parts, we are large in issuing space. The wallets business, we provided an update. We are now adding 3-4 million a quarter of wallets. So that's the issuing side of the business. If you take the acquiring side of the business, there is P2P, there is P2M. In P2M, there is a point of sale business and the payment gateway business. We will play all four. We are in the middle of hiring reasonable amount of talent in the payment space. We are doing this with a 3 to 5 year view. End January, middle February, we will launch P2M business. Now, first part, which is a multi-QR business. Follow that up in June with rest of the pieces between June and July with the full product suite, and build this out to be a large business. The last point I must make, when we look at the business across, let's say, P2P businesses like 3 names that we know dominate the market. One of the areas that we find is they've continued to aggregate business mainly by offering cashbacks and so on and so forth. We have competed in the point of sale business in the last 3-4 years with people throwing reasonably funny amount of money between even established lenders. Did not make too much of dent even in the point of sale business that we run. To counter that, over time, we built a reasonably large partnership frame with merchants and created what I would call a voucher management infrastructure. Overlay on that, what I would call a broader thematic expression called rewards. So we'll use this payments business to power and create what I call a rewards business, which will also provide velocity to the financial services business. That's really how you should see, that's how we see this frame to be. This is a medium-term frame. And as I said, we are hiring talent. We're building out the technology stack. And that's how we see this to be. Knowing fully well, last point, that this burns money. You can stretch the Excel as far as you want. You will never make money. We know this, and investing in it with a very clear view that this will power the Xperia app business. Keeping customer engaged on the app allows him to hold the app and allows us to sell whole host of financial services to him or her. That's
perfect. No, this helps. Just as one follow-up, in terms of the number of merchants that you eventually sort of wish to acquire, any thoughts around that? I mean, most of the large players are between 15 to 20, 25 million. Any thoughts eventually? What's the target addressable segment for Bajaj? Any thoughts on that?
So technically, let me put it another way to you. And I made that point earlier, right? That if you have 15, 16,000 boots on the ground, aggregated together, the 3 large guys don't have. Number one. Let's take a simple situation, and I am not being, this is a serious conversation. When we look at a point of sale business, we find that between 12 and 3 and 6 and 10 is when these 16,000 boys are busy. The rest of the time, they do what they do at the store. Hypothetically, if they were and I talked about the productivity apps earlier, which is why we are not building 2 app ecosystems, which is just the consumer app and the merchant app. Behind it is a very large framework of productivity apps, as we call them. One of the productivity apps is Sales One app, which will bring our staff in this entire ecosystem, which will or is being launched at this point in time in phases at a design level, which will bring the entire ecosystem on a single app called Sales One app, as we call it. Imagine that each one of those boys can add between 30 and 40 in a 1 mile radius merchants, and do the numbers. We pay them for it, of course, and they add merchants for us at a variable cost. Is how we are looking at the business model to be. And so if it's 15,000 and you're doing 30, that's 4.5 lakh merchants in a month. You can keep pulling the Excel. The point is not of Excel. I must just make that point double. We're doing this knowing fully well that we have an economic model which delivers reasonably sustainable profitability. And if we want to be a payments business, we will invest in the business, and that investment leads to more stickiness. So that's a virtuous cycle we are fundamentally trying to create. So if I push the conversation, right, to the one number that you're asking me, is it possible that in 22, 23, we'll do 3-4 million merchants onboarding in 3,300 cities? Possible.
Perfect. Useful. Just one final thing. In terms of the digital EMI card onboarding, any initial trends, learning that you have compared to the existing offline franchise? Any sort of comments? Is the behavior similar, different, propensity similar, different? Any comments there would be useful. Thanks.
First comment is in 2016 we launched in Diwali, and I have my colleague Manish Jain, who used to be marketing head then, sitting here. We launched, that was the only time I did an ad, and that too in Times of India, half page, saying 3 clicks and a happy Diwali. I think finally it took us 5 years to do 3 clicks and a happy Diwali, only in 2021. But I think lots of learnings. I think it's easy to learn. So when we learned then, we did have 100,000 customers during a 3-month period. Lots of BNPL type losses. Let me make that point. We never left that path, however, if I may say so, and kept at it. Of course, as the country also has digitized dramatically between that period, to be fair to Manish Jain. I think the country has dramatically digitized. I think the ecosystem that the regulatory or enabling infrastructure that has got created by the country is enabling digital India to be a reality. Let me say that. And that's happening rapidly, even as we speak, right? So I think that's made 210,000 customers just in the month of October. Of them, 100,000 paid customers. So this is not about onboarding customers. 100,000 are paid and 110,000 are approved. Of these 210,000, 30% of the customers between 60 to 90 days walk into the store and become active. Because eventually our intention is to make them give a loan. Our intention is not just onboard customers. So 27 to 30% active rate in 60, 75-day period, depending on the seasonality. We've gone live with Flipkart as well on the same infrastructure. Just in October, we are testing that at this point in time as we speak. So quite excited. I would say this will be fully available on 15th of December, but we don't offer it to everybody. Let me make that last point. We offer it to a set of customers or a set of prospects that we identified working over time. I still believe if I did it to an unknown client, I will have the same experience 2016. That's our reasonably strong point of view. It is to mind curated people or prospects that we want to do business with, and then we target them through using various digital means and onboard them. So that's the experience, and we're quite excited.
Great. I'll take it to the next question, which is from Nuno Fernandez of GW&K Investments. And you've kind of answered this, but I'll still read it out. Can you please give us some more details on the segments where you're seeing too much competition? Who's aggressive in pricing wise, and how are you reacting?
I think, as I said earlier, until country has a 6.5% bank rate growth, we will see competition across all lines. So I think there is no space from mortgages to autos to used autos to personal loans. Competitive activity is in gold loans. I mean, competitive activity is intensified everywhere. That's why I said I found it a little surprising that at the point of sale, we found competitive intensity to be a little soft. So there is mispricing happening across. Let me make that point as well. So that would be a general point I would make, and that won't that won't go away, is also a point I have. So we're prepared that this is a little longer haul. First it gets mispriced, then it gets mispriced for risk, and then it corrects. So it's normally a two-step process. People think they're offering lower price to better credit, then they start offering lower price to poor credit as well, and then the bubble bursts, and then sanity prevails. So we are in this for a little longer, unless and until there is a massive capex revival that happens, and we see lesser competitive intensity. I don't see any other way competitive intensity will go down other than capex revival.
Got it. We have the next question from Praful Kumar of Diamond Asia. He says, on AI-based platforms, what exactly are we doing? Please elaborate. And when all your platforms become live, what do they do to costs, as I guess cost to income ratio and growth momentum?
So there's reasonable amount of work in ML space that you're doing based on, just to give an example, based on consent at the point of sale. You download an Xperia app. If you give a consent to take credit, we read your SMS data and give you draw real time a set of variables and approve. We use apographic data. So based on consent from clients on a real-time basis, we're doing a lot of work in this space. So I think I just to give an example to make the point, and there are various other things that we're doing in this space and one example that I gave you should suffice. We are doing lots of work on facial recognition at stores. The mask took it away. So the mask go away. We were reasonably ready that at point of sale, we tested it in a few stores in Pune and in our branches to identify customers so that we can help him with offers at point of sale and with service in branches. So I'm giving you two examples to make the point. Cost to income ratios, it's a fair question. I had a particular view, let's say I would say 9-10 months ago. That view is a little bit work in progress. Given it's also partially caused by the earlier point that I made on crunch in tech talent and the kind of demand supply gap that we're seeing, leading to significant what I would say compensation levels going up dramatically for the tech talent. I do have a view that it's we will see little more pressure than the number that we forecasted or I forecasted when we embarked on business transformation than I see at this point in time. Is it possible to give you a number that I thought will look like 27-28%? Is it possible we'll look like probably 28 to 30%? Answer is yes. We're also significantly expanding what I call the high availability infrastructure, the BCP infrastructure that we've landed up investing in for the 15 December go live. So on the tech side, people investments on one hand, significant redundant infrastructure on the other hand has been created to ensure that we don't see downtimes other than the BCP infrastructure. So that's really how it's work in progress. If the velocity turned out to be better, it's possible the OPEX to NIM may look the same way I thought. If it doesn't, it's possible instead of 27-28%, could it look between 28 and 30%? It's possible. But it's work in progress.
Okay, fair enough. We'll take the next question from Abhijit Vara of Sundaram Mutual Fund. Could you please unmute yourself? Abhijit, we can't hear. You're on mute.
Hi, can you hear me now?
Yes, we can. Please go ahead.
Yeah, yeah. So thanks for taking my question, sir. Could you please talk about the trends, geography-wise trends this Diwali? Whether you are seeing any difference in momentum across the country, and if you compare versus the past seasons, I think you did make a brief comment, but how is it panning out, and also the momentum in the near term?
By states, we are seeing very similar expression, and we are quite granular. We originate during that period reasonably large volume of applications. So, from Kashmir to Kanyakumari, we are not in Kashmir, we are in Jammu. From Jammu to Kanyakumari, we are largely structured. Of course, we're seeing higher growth rates in central India because we were less present there. So year-on-year data in some of the geographies that we were less present in may not reflect may not be a fair representation of the question that you're asking. So adjusted for that, I think reasonably structural. As I said, volume-wise, season has been good. It was okay between 20th and 30th, picked up between 1st and 7th very strongly. Value-wise, it's been better than good. That's, and I do believe if there's no third wave, overall, as economy normalizes, as consumer confidence comes back, we should look stronger with every passing month. Because look, at the end of the day, I can offer. Consumer must feel confident and be in a mood for discretionary purchase. And that will only come from normalization of the economy. And if he or she does not have the fear that COVID can make a comeback. Are we ready to respond? The answer is yes. From a present standpoint and from a proposition standpoint.
Just one follow-up, sir. Apart from third wave, is there any other concern you would have, probably inflation or anything else which might hit the growth momentum?
Inflation, I mean, inflation cycles mainly have impact on interest rates. As Sandeep mentioned earlier, our liability book is longer than our asset book. As he said, in down cycle and up cycle, both cycles we borrow long. Because we take various risks, that's one of the risks that we don't like to take. We talked about even in our quarterly presentation on second quarter, we've raised 10-year monies at 7% in the quarter that went by, close to 2,500 crore. So we're continuing to borrow long. We've not seen money at these rates in our last 15 years of transformation that we've been up to. So inflation risk doesn't bother me that much. It will cool the economy, but that will be good for the sustainability. If inflation risk does emerge into Reserve Bank and government taking actions, and it will be the right thing to do, because overheating economy never helps.
Abhijit, does this answer your question?
Yes, Piran. Thanks for your views, sir.
Thanks. We'll take the next question. So Abhinav from SBI Life has asked, is there any plan to partially shift acquisition engine from offline to online?
EMI card is one example, Abhijit. Abhijit, was it the question? Sorry.
Abhinav from SBI Life.
EMI card is one example. As the new December 15th we go live, a whole host of prospects, depending on we are willing to do business with those prospects, will be able to do business with us. So that should further accelerate momentum. We have curated this prospect ecosystem, working with our retailer ecosystem over the last many years, and offers a pre-approved option to the customer across multiple products. Today we reach out to them through traditional channels, we'll be able to reach out to them through a fully digital channel. So I think, as I said, strategy is to be omnipresent. I think that's the one word that you'll hear from us from a next 3-year standpoint. And the reason is, to the earlier question, even from a mortgage standpoint, we are a highly regulated business. Financial services anywhere in the world is highly regulated. So unless, we'll need touch. It's given. Whether it's for KYC, for AML, for debt management, for service, we'll need touch. So the touch requires that we are omnipresent rather than either only offline or only online. We will have to be omni-channel stroke omnipresent. And we'll make progress in both the areas aggressively as we move along over the next 2 to 3 years.
Fair enough. So one of the other questions by Anand of White Oak Capital, he says one of the largest UPI payment apps is now offering FDs. Another one has an insurance marketplace. And given the dominance and the stickiness of these apps in the payment space, how would we get someone to try our open architecture Bajaj Finserv Markets app?
No, look, we want to do more and more. Our strategy is to acquire and cross-sell. We are not interested in what others are up to. We have 53 million customers. We are originally 8-9 million new customers a year. All goes well, 3-4 years, we'll have 90-100 million customers. We just want to do more with them. That's our only trip in life. So we are not interested in what others are up to. We just work on we manufacture and distribute. They only distribute. Please mind you, you want to reduce friction at a broader financial services level, you'll have to manufacture sometime or other. I have a reasonable point of view on that. And those who manufacture eventually can reduce friction, because you got to innovate in financial services at the nuance. So that's all I would say. And you have to be at it. Let me make one last point. You have to be at it. You have to continue to make improvements on a daily basis to make that happen. And we'll just keep making improvements. As I said earlier, we're not launching an app. This is the way we'll conduct business going forward. I think that's a point I keep driving, so that this is not a hobby. This is a repivoting of the way we are running the business or will run the business. And so it's a massive internal transformation that the company is going on, in addition to running our day-to-day life, which is to grow, to do whatever we were doing pre-COVID. It's also a point I must emphasize, and I forgot to make that point, to the earlier point on why the delay happened. The day job is to run the company. The night job is to do transformation. So we can at times prioritize between the day job and the night job. So that's, and in between the two waves, and in between various things that have happened.
Fair enough, sir. You all have done a very commendable job. As we come to the close of the session, there are many more questions, but we'll have to wrap up here in the interest of time. Thank you so much once again for attending our CLSA conference, and hope to see you next year too.
Thank you. Thank you for hosting us. Thank you.
No, absolutely our pleasure.
Thank you.
Thank you. Yeah, bye.